Hello, everyone. Welcome to another Fratarcangeli market update that we're bringing in some special guests to talk through. It's another call to action. You'll notice over the years, many of you that have joined us in the past, that we tend to do these where we see a crossroad, where we see some changes, where we see some concern, if you will, relative to the economy or events that are transpiring. For those of you that are joining us for the first time, Fratarcangeli Wealth Management is the firm that I founded going back almost 32 years ago. And we are currently in 4 states representing clients all over the country. And what we like to refer to our practice as wealth management is best in class, bringing solutions to our clients that give a 360-degree purview of all the financial aspects and decisions that need to be made, creating a competitive environment towards those solutions, whether it's being investing, insurance, tax planning, estate planning, and certainly navigating the markets and many other factors. And here we sit today in the second year of what we refer to as a first-term presidency, in the middle of an election year that's coming in November. We come off the heels of yesterday's preliminary, call it elections, getting prepared for the ultimate election in November. And what's brought in that type of environment is a great deal of uncertainty of what happens in November. It brings a great deal of narrative that brings some polarization as one side of the aisle that has control, in this case, the Republicans with the House, the Senate, and the presidency, wanting things to look better than they probably are. And on the other side of the aisle, trying to regain control, trying to make things look worse than maybe they are. And the media and the narrative typically aligns to either of those objectives. Our job is to be the calm in the storm. Our job is to leverage our network, bring in folks that are trusted, folks that I've had the benefit of working with in some cases decades, to leverage their knowledge, bend their ear, and talk about where we think things are going. So I welcome you all for this call to action. And I, more importantly, for this moment, welcome my partner over the years, Robert Carey, the Chief Marketing Strategist at First Trust, with over 3 decades of experience. I think it might be 4 or 5 decades now. This might be an old bio. He's a Chief Financial Analyst, a CFA as we refer to it. He just puts a calm in his message, and he talks in ways that are easy for the layman that isn't in the financial markets to understand. And I respect you a great deal. And I remember going back to the election when Trump lost the first time and the new regime was coming in, and you came in and created a calmness. You gave us guidance as to what you envisioned. I also remember when the markets were trading at low levels back in 2016, and you talked about the risk reward as it related to fixed income versus the equity markets when no one wanted to buy a stock. And I got to tell you, Bob, we listened then, we'll listen today. You were right. And I look forward to your interpretation of where we're at. And let's jump right in. We have the Iran conflict. It'll be hours, if not days away before that peace discussion reverts back to heavy bombing. And the oil prices go from $75 a barrel back up to 100. I hope not, but that's, of course, what we're all holding our breaths for. When does it end? What happens with oil prices? And when does that straight start moving and flowing with the necessary ingredients being oil and many others that we need so badly here in our supply chain? What says you, Bob?
Well, oil. Thank you, Jeff, for the kind words. Oil has definitely been in the headlines now for almost 5 months, which is pretty amazing. Obviously, oil prices are up this year. Inflation expectations have gone up as a result of that. I remember I did a meeting back in the early part of the year, and one of the things that I said I was going to be focusing on back then, and I obviously this has been true ever since then, is the fact that the price of oil prior to this conflict breaking out, the price of oil was exactly where it was 20 years ago. Think about how much prices have gone up for everything over the last generation or so. And for the longest time, essentially the price of oil was flat. And obviously oil prices have increased quite a bit as a result of the conflict. I think ultimately the reason that prices were kept so low for so long was because of fracking here in the U.S. We allowed fracking to happen. We've become the largest producer of oil and gas in the world. And at the same time,
why am I on mute?
Jeff,
sorry, Bob. Go ahead.
Okay. Yeah, I just want to make sure everybody's good. I can hear you. So anyhow, we've got all this, this supply that we've started to produce, and this has been we've talked about this before. This is I think a massive game changer in terms of geopolitics, and what that did is that it gave us some ability, I think, to withstand an increase in the price of oil. If we had the kind of oil production levels that we had 20 years ago, 30 years ago, 40 years ago, we'd be talking about a much, much higher price of oil. I can only imagine. I mean, I think it's not inconceivable that oil would be $200 to $300, maybe even $400 a barrel, if in fact we were to have taken the action that we've taken against the regime. So obviously, nobody likes to pay more for oil and gas. I mean, it's I complain about it all the time, and yet when you take a look at what we pay for energy as a percentage of our incomes and our net worth and all of that. Before this started, we were essentially at a 60-year low in terms of just how much we spend on oil and gas. Do I like paying more for oil at the pump? Absolutely not. But at the same time, when you take a look at it from a bigger picture perspective, most people have not had to change their habits. And the other thing that's important is natural gas. We're in the midst of this massive capital spending boom in this AI age, this artificial intelligence age. We're putting up data centers all over the world. You hear the term neo cloud. You've just got a lot of things happening in that particular space. Most of the electricity driving AI is coming from natural gas, and natural gas prices actually have not gone up this year. They did initially when the conflict broke out, but natural gas prices as of the other day essentially were down on the year. So this is clearly the major driver of economic growth here right now. And as long as the price of natural gas does not escalate for some reason, I think the capital spending boom that we've been going through is likely to continue. So this has been a big story. Your question was, when does this end? I don't know. I mean, I think clearly we have the upper hand from a military perspective. I think the one constraint on President Trump is the fact that it is a midterm election year, and I don't think Trump wants a war in the headline. Or in the headlines here in the weeks leading up to this election cycle. So I think there's a little bit of urgency to get something done, and obviously getting oil to the market is a priority. This is not because of a lack of production or productive capacity. This is just simply a more or less a transportation issue as much as anything. And I think a lot of players in the energy business around the world, the transportation business, have learned that there are other routes that they can take. And I think that, Iran is, they've had leverage literally for 50 years almost with the Strait. But I think they're losing some of the grip on that. And I think one of the reasons why oil prices have come down as much as they have. They're still up on the year, but, they've been bouncing, closer to 70, 75 here, more or less the last couple of weeks. So I think it's, my guess is that we will have some resolution, if you want to call it that, sometime soon. But obviously, this is a regime that is fractured. We really don't know who's in control at this point, from everything I'm reading. And at the same time, investors are beginning to realize that and I think ultimately this doesn't really matter as much as we might have thought maybe a couple of months ago.
Wow. Well, what I'm hearing is the impact and the cost of energy in general, gas and oil, hasn't been affected what it would have been just decades ago, and that's a positive. And I also hear you saying, when does a resolution happen in an area that's never had a resolution? I heard the statement that never won a war but never lost a negotiation, right? And that, I think that's who we're dealing with here. And they may have met their match. We'll find out. But I think I also hear you saying we have to navigate this election, as the United States is a free country that we vote for our next leaders and folks in the different pockets of our country, and as well our president in due time. And so therefore the alignment to making sure we have the outcome that's preferential on either side of the aisle is going to be a motivation to the end of this conflict prior to November. I can make many comments about the timing of these peace memorandums before July 4th, or before this recent primary this week, and maybe there's some reason for that. Who knows? We'll keep that between us, Bob. But the reality is we are in a position where we've come to the conclusion that it's not as important. There's other ways of getting the transportation mechanisms in place to their destination, and the prices have reflected that. And the markets are showing explosion on earnings, which we'll talk about. But before we get there, Bob, We have this Kevin Warsh, right, and his dot plot and his lack of foreshadowing of the the next rate move, the data dependent Fed that we're waiting. And I have many opinions on the item and the issue, but I want your opinion. What do you anticipate the Fed will do, and how about this conflict that they're calling an interfamily dispute with the dissent? Where do you envision the inflationary pressures going, if not hopefully going away? And where do you see the Fed's next move? And what's your interpretation of that whole debacle?
Yeah, I think it seems like every single time we get a new Fed chair, and I've been watching this for a long time now. It seems like the new Fed chair gets tested, and it's an event happens around the world, and or something happens to the economy. There's a political development that changes. All those different things seem to be issues that are being thrown at the new Fed chair. I think ultimately, I think if you look at the Fed, and if you're Kevin Warsh, and you look at the last 4 or 5 or 6 Fed chairs, the ones that you hold in the highest regard are the ones that have been the most disciplined at keeping inflation down. And Greenspan, like him or not, he ran the Fed for 19 years. He did such a good job that after his 19th year and he retired, they made sure that nobody could ever serve 19 years ever again in Washington. And if you look at at what Greenspan did throughout his term, for the most part, he held basically interest rates above the inflation rate for most of those 19 years. And what he would do is he would basically have some room to cut rates in the event and when things happen. And a lot of things happen, obviously, during those 19 years. I think Kevin Warsh looks at that and is smart enough to realize that that's probably the best way to go. And right now, we've got short-term interest rates at 3.75%, just a little bit below 4%. If you look at the bond market this year, the 10-year Treasury note started off at around 4.2%. Now it's 4.7%. And I think the market is saying, hey, we think this guy might actually raise rates. And who knows if they will. I think he's keeping his cards very, very close to the vest. I think ultimately the fact that rates are at 3.75, so they're not at 2.75 or lower, means that he's got some room to be patient. He's got high enough short-term interest rates. The rest of the curve has also raised rates for him, essentially. If in fact all of this is inflationary, he's been able to tighten without actually raising short-term interest rates. So I think it's going to be very interesting to see what he does. I think ultimately on the other side of this conflict, we will see oil prices stay relatively contained, maybe go down even further from where we're at right now. And I think we're going to be talking about a different level of inflation than we have right now. I think we'll see inflation trend back to that 2.5, maybe 3%. I think the talk about 2% inflation rates, that being the Fed's target, I think that's going to be almost impossible to get inflation down to those 2% levels. And I think Warsh realizes that that's going to be a challenge. So I don't think he's going to be in a hurry to cut interest rates, even though the inflation numbers are going to get better. And I think ultimately, short-term rates aren't going to change very much. I think they're going to be right where they are for the foreseeable future. And obviously, that's it. Data dependent is the correct phrase. It really gets back to whether or not the Fed thinks that they can hold off. And I think that's going to be his objective, is to basically keep the market guessing and let the market do some of its job. And its job right now is raising interest rates without the Fed actually raising rates.
Yeah, good assessment. I guess short term, does this Fed chair raise rates in the middle of an election like the last Fed chair did last election, or are we going to see nothing until after November?
I think I'd be shocked if he were to raise rates before the election. I think he's just going to try to more or less get the Fed out of the headlines for the time being. I think this is going to be something that'll be if they do raise rates, it's probably going to be after several months, maybe even quarters of inflation running hotter than expected. And I think that's not an inconceivable scenario. So, but I think this Fed chair has got some room to basically hold off and be measured and not react. And I think that's what he's going to do.
So in summary, no race, no move either direction prior to the election, and probably after the election, recent or call it directly through the end of the year. And what I'm also hearing is rates are moving on the 10-year and the 2-year and the 30-year, just based on narrative and factors and data that we're getting on a week to week basis. And so letting them do their thing without making any changes, and maybe going back to the Greenspan era where we have rates a little bit higher than the inflationary rate, which gives the Fed ammunition to move things if need be without creating major impact overall. And so that I see that as a positive. I got to ask, this data that we're getting, that for years we were getting a data point, unemployment, for example, or GDP, and then fast forward a month or 6 weeks, and they get, oh, we readjusted it. It's half what we thought. What's going on? You've been around for a good decade longer than me at this 30-year race I've been involved. What do you interpret that as? In today's modern capability, we have trouble getting data. Tell me why.
Yeah, I think the reality is that economic data, when it comes to government releases for the economic data, I think by the time we hear from the Commerce Department, the Labor Department, there are so many other sources that we can use to gauge, in effect, how the economy is performing within sectors, within industries and companies. I think the data that we get from the government is, it's always been, basically a little bit delayed. But I think in this day and age, I think the private sector is doing most of the heavy lifting as far as keeping track of where the economy is going. Now, we'll always use government data for certain things like inflation. The Labor Department still basically calculates the CPI. Do they do it perfectly? I mean, it's, the Fed itself actually uses a different measure of inflation than the CPI when they come up with their inflation expectations. So there's a lot of, that's maybe the good thing about living in a free economy and basically in the West, is we've got, we're not captive to the government's statistics. We have a lot of different ways of calculating this. So, one of the questions that I've had for the longest time is, where do they get some of the data that they get? And I think one of the issues that we all have is that we're all different in terms of what we consume in the economy, how we invest, how we save. Everybody's got their own personal economic situation, and somebody's inflation rate is going to be different depending on where they're at from a demographic standpoint, where they're at from a career standpoint, from a retirement standpoint. Everybody's got a different basket of goods and services that we buy. So I think at the end of the day, I take some of these numbers and I think I don't really view it as gospel. And the fact that they revise the data, a week later, a month later, it really shouldn't be a surprise. And it doesn't really seem to move the market all that much ultimately.
All right. Well, that was a little bit of a dance for me there, Bob. But I think I hear you clear that don't be so hanging on every item that comes across our media outlets on data points, GDP and such. So we watch closely and we let it have its trend. So appreciate that feedback, and we'll just keep our eyes and ears peeled to the next call it factor that comes down the pipe, whether it be the Fed or data points that we see. I'm going to pivot up for a moment before I come back to the market, specifically in the equities and bonds and interest rates. But that's the currency market I'm going to pivot to, and the fact that recently in the last week, our country stepped in and supported the yen to the disadvantage of the euro. How important is that? What's its impact? Why did they do it, and how does it impact us, good or bad, if at all?
Yeah, I think this is interesting. The yen has been weakening against the dollar for a very, very long time. The reality is that we have a lot of investment coming from Japan. The Japanese own a fair amount of dollars still at this point. The treasuries, they have proven to be a solid ally in many respects. Obviously, they are very close to North Korea, and China's not that far away. They are clearly our most important ally in Asia. And as the Asian economies have grown over the last 10, 15, 20, 30 years at a rate much faster than Europe, I'm really not that surprised that we view Japan as something that we should pay maybe the most attention to from a trade perspective, from a geopolitical perspective. I'm not a big fan of the government's intervening necessarily. I think there's a chance that they could screw this up, and maybe this temporarily stops the fall of the yen. But I think over time, currency markets should be left alone. But undoubtedly, you're going to get a lot of criticism if you don't do something, and you're going to get criticism if you do something, if you are the U.S. Treasury. So, but I think clearly Japan is asking for some help. Japan has a lot of debt to roll over. Right now, we do as well. This is, I think, one of the dances that we all face. Whether it's Japan in the east or whether it's countries in the west, we have a lot of government leverage at this point that we have taken on over the last 10, 15, 20 years. And ultimately, I think all of this is a result of just spending levels that are very, very high. And Japan, I think, clearly is beginning to recognize the fact that they have issues with their demographics. They don't have really much economic growth to speak of over the last 25, 30, 40 years. It really is amazing. When I started my career in the mid 80s, it seemed like Japan for the next, at that time and in the years after that, shortly, they could do no wrong. Everybody looked at Japan like, boy, they're just going to run the world at some point here, if not already. That was the mindset that people had.
Right.
And if you look at the last 35 years, there's no economic growth. I mean, it's still very much an industrialized country, a great ally of ours. We continue to import a lot of things from Japan. They continue to be very productive people, and their companies have invested massively here in the United States over the last 25 to 30 years. But at the same time, I think they realize that they have to grow their economy, and they've got to make some reforms. And it's hard. It's hard to change. A lot of business and politics go hand in hand in a country like Japan, and more so even than our country. And the governments have basically propped up a lot of assets and a lot of economies within the economy over there, and a lot of companies. And I think they realize that they've got to make some reforms and let these companies free and let them become more competitive here in the global economy. There's a lot of technology in this AI stuff that comes from Japan. I mean, we need them to remain productive and competitive, and also an ally in that region.
All right, great. So you can hear me. I'm having some audio issues. Glad you can hear me. So what I'm hearing is we have an ally in Japan, which is certainly a good thing for many reasons. We have manipulation of currency. That's something we'd like to stay away from. We're hoping this isn't going to create an issue. But what I'm also hearing you say is we have a treasury that not only are we seeing a substantial rollover of those treasuries coming due and how we navigate positioning those maturities and cost of interest. Let me remind you, our audience, that when we borrowed against these treasuries back years ago, the rates were half of what they are today. So we're gonna be adhering to a higher interest rate. Then we have Japan, who also carries a lot of our treasury, and we want to make them to continue to be that supporter of our treasury. And so I think there should be a little bit of business being played here, and also how important our ally is to us, and making sure that we protect them in their currency. And they're being a good ally and such, being for the global economies, we want to maintain their strengths. And so I think that's as clear as you can be at this point. Some concern, but yet thinking it's the right move short term, and we hope it doesn't affect us. Here we are today. We're constantly hitting new highs in the stock market, the Dow, the S&P, the NASDAQ. And I remind everyone that we've had multiple contractions along the path of higher highs. I don't think we've forgotten too soon the, call it March and April decline that we felt last year. And we almost felt deja vu here this year with the same, not necessarily as low, but certainly a contraction. Let me remind everyone, once a year, the market typically pulls back 10% one time. And then then every quarter we get those contractions historically. And, we've seen every other year 20%. So this is the somewhat norm. But here we are today at new highs. I mean, the narrative has been negative on CapEx spending, the inflationary pressures, the issues with Iran, to say the least, all of these uncertainties, not to mention the election year. But yet here we are with earnings upon us. Here we're about I don't know, maybe we're at the 50-yard line for earnings season here in the second quarter. We're seeing the markets run and rally from a contraction that transpired for about 2 weeks. And here we are touching on potential new highs. What is your opinion of the relative broad strength across various sectors and the general market, not only this year, but going out maybe if you can through next year post-election?
Yeah, Jeff, you hit the word is earnings, and you said it several times. If you think about uh, where we were at the beginning of the year, and if I had told you, or if you had told me that oil prices would be up this year, that the 10-year Treasury yield would be up 50 basis points, we'd be at war. In most years in the past, all of that would have added up to a lot of pressure on the stock market, a market that potentially would have been down even. In fact, probably more likely than not actually negative on the year. And yet here we are, most of the averages are up double digits here to start the year. And the only reason for that is the fact that earnings have been just lights out. Earnings estimates at the beginning of the year were encouraging. And when we take a look at where we're at now, after we're about 2/3 of the way through earnings season here for the second quarter. So when we look at what we've learned so far from an earnings perspective, and then we plug in earnings estimates for the third quarter and the fourth quarter, and then increasingly we start looking at next year. We've got basically an earnings picture that's spectacular. Right now, earnings estimates for the S&P 500 imply that earnings are going to be up 27% this year. Now, we won't know whether or not those estimates are correct until well into next year. So we're talking probably March by the time we'll know. And then at that point, we'll be looking at 27 estimates and probably 28 estimates at that point. So the market's always looking ahead. But when we have these kinds of environments where earnings are coming in better than expected, earnings are getting revised upwardly, that is a very, very bullish component to the market. And I think the one thing that is different this year than what we've seen over the last several years is that it's not just the Magnificent Seven that are doing well. Earnings estimate revision market at this point, whether you look at the equal weight S&P, mid caps, small caps, earnings estimates are higher now than they were at the beginning of the year. And so we've had a really good year, especially in mid caps and small caps. We had really a part of the market that a lot of investors have forgotten about. That has been the place to be. In fact, there was a point in time here just a few days ago where the Mag 7 index was flat on the year, and small caps are up almost 22% year to date. So you've got just a huge delta in terms of what we've seen. And so if you look back and you look at the S&P and you look at how it compares to mid caps, small caps, the equal weight, the 5-year numbers still heavily suggest that, hey, you want to be just in the S&P 500, maybe just the Mag 7. But if you look at the market in the last 7, 8, 9 months, the market has pivoted. It's broadened out. And that's, I think, very, very encouraging. I don't like markets that get narrow. They scare me. And this is a significant change that I like to see. Now, earnings continue to be really good for the Mag 7. In fact, if you look at the tech sector in general in the second quarter, earnings are up almost 30% year over year for the tech sector. If you strip out the tech sector from the S&P 500, earnings are still up 17% year over year. So that tells you that these companies they're obviously spending a lot of money on technology, but those investments in the tech space are I would argue are making sense. They're paying off. Companies are getting better. They're getting more efficient. All of this has been going on for a long time, but I think now we have more technology. To me, AI is super search, right? It's just basically it's one of the challenges that we've had in the internet age is we've got information all over the place, and I think what AI is doing is that it's concentrating effort where it needs to be placed, and where can we get better at what we do. And I think ultimately that's where all this is coming from. Data centers have been around forever. All these things, there's nothing new about, the improvements in computing power and chips and all that kind of stuff. But now we are doing it at scale like never before. And we continue to have, capital spending levels that are historic. This is the biggest boom in capital spending that I can see looking at the data. You probably have to go back to the 1950s, maybe into the 1960s, when you take a look at a sector like the automotive sector. I know you're a Detroit guy. That was the boom era for Detroit. We now have, I would argue, a much broader application throughout the entire economy. I don't care whether you're in the utility sector, retailing, manufacturing, software, financial services. You have to spend money on technology to remain competitive, and it's a really interesting time and a very exciting time. We've got companies that are pushing the boundaries on a lot of different things that we've never seen before.
Wow. 27% earnings growth year over year, 30% earnings growth for tech. Let me remind everyone, we've had these conversations similar to this with different guests, and we were calling on a 17% earnings growth for tech, and we were calling for a 13% earnings growth for the overall market. Now we're talking about 27% earnings growth for the entire market, 30% earnings growth for tech, and 17% earnings growth for the broader market. And if you have one sector that drives, call it earnings and as well valuation increase like the Mag 7 did, that's not a bull market. That's a bull sector. What we have is a domino effect into other sectors, which generally states that we are in a bull market that could be considered secular. And, the narrative that we would hear on different time frames would lead us to question that. And yet with the data relative to earnings continues to support that. And that's what I'm hearing loud and clear. And I got to say, Bob, I know you very well, having worked with you for 20 years plus and having conversations with you at some of the toughest iterations of time historically, whether it be 2008's financial collapse or the 2016 scenarios where we saw, a risk-on negative flow of money, and yet the treasuries were getting high monies going into them. And you guided us at a very calm voice of why that doesn't work. And today you're guiding us on why the equity market still and the overall broader economy is still in go mode. But I have to push back, as I always do, Bob, not because I necessarily think you're wrong, but because I need to hear what you think. And that is, we feel it. We feel it every single day, whether we're going to the gas station or whether we're buying groceries for our kids or whether we're going on vacation or whether we're buying a discretionary asset and we're looking at the prices, whether I'm putting new windows on my house. The prices are outrageous. Inflationary cost to the general mom and dad and family out there, and let alone businesses, is something that, granted, I was a kid when we had the 60s and the 70s scenario of massive inflation. How can that tip us at any point? Or is the demand and the spending that's going towards this AI efficiency going to outweigh and eventually have the domino to the wealth effect that will allow us to sustain our lifestyles? What do you think, Bob?
Yeah, I think ultimately labor markets are going to be the decider of that. I mean, if you take a look at wages and you adjust all of the wages for inflation, that is where the rubber meets the road, whether or not we can continue to spend money. And the fact is, we have the cash and we have the cash flow to continue the spending. I think part of the issue we're dealing with is we got used to inflation being essentially close to zero for a long time. I mean, all those years after the financial crisis, we really didn't have much inflation. I would argue that inflation right now, the trend that we're grappling with, is about a 3.5% inflation rate, maybe closer to 4 when you throw in energy prices. And historically, inflation in my lifetime, I was born in 1963. Inflation in my lifetime has averaged 3.8%. We just, I think, kind of got used to inflation at maybe closer to 1.5 to 2% for a long time. These are inflation numbers that are actually in line with long-term averages. Do I like it? No, I don't. But what that does is it forces us to basically adapt our spending, maybe adapt our investments. And I think the days of inflation going back down to those rates, maybe if you're right that all of this spending in AI makes everything more efficient, more productive, I would hope that we would see inflation rates come back down again. But I don't know that I would really expect inflation to trend back downward. I think that we're likely to see inflation stay at a relatively high rate for the time being.
Can you hear me, Bob?
I can now.
Yep. So adapting, and we talked about this with everyone. It's create a plan. Know what your income
hard.
is.
It's hard, tough. Right? It's not easy. I filled up my tank last night. I've got a big V8, and I'm just like, but the reality is the V8 that I own gets 25 miles per gallon. The V8s that my parents drove back in the 1970s got, 11 miles per gallon or 12 miles per gallon, some of them. So we've become better. We've become better at making more with what we have and just becoming more efficient.
That's it.
Sorry to
And
interrupt
having
you.
it starts with having a plan, understanding what your income is, understanding today what your new expenses are, understanding what your discretionary income and controlling the things you can control. And, as it relates to creating efficiencies, as we get into this explosion of earnings and capital spending, and all that domino can bring. And I remind everyone that I was sitting in this position back in the 90s, watching the first iteration of the tech explosion called the information age. And now we're in that second iteration, and being in more of a learning and always learning situation, more so back then, kind of seeing how this plays out and seeing how this can be more impactful to how we operate and how efficient we can be. And, I don't think we've even touched the surface, whether it's with bots coming down around the corner, or being able to execute upon business in ways we can't even fathom. I believe that the efficiencies that are coming will be far more impactful to a lifestyle, as well as a more just more productive economy globally, domestically, and all the above. And right now we're kind of in that in between phase, kind of that teenage years as an adolescent, before we really feel our oats and are out in the workforce in a way. That's where our economy is being affected by this. And I think I have an opinion. I believe the best is yet to come as it relates to our lifestyles and the markets in general. But where do you see us, if you have the foresight, a year from now, or maybe even a year and a half from now, as it relates to the opportunities that the market brings, and what we see post-election?
Yeah, I think I do expect that we're going to get some volatility in the days and weeks leading up to the election. That seems like that's always been the case. You never know what the market's going to trade on. Polls come out and whatnot, but I think ultimately, right now, the expectation that the market has is that the Republicans keep the Senate. Obviously, they will keep the White House, but the House of Representatives will go to the Democrats. That is, Republicans have a small enough majority that the midterm cycle usually goes against the incumbent president's party, and that anything outside of that scenario would move the market. I think if the Republicans somehow manage to keep the House and the Senate, I would expect that we'd get a pretty significant rally. I think the markets would view that as a very positive development. If the Republicans were to lose both the House and the Senate, I think the markets would initially not react very well to that. Eventually, the markets would realize that at the end of the day, that means that policies probably won't change much going forward. I think ultimately we have two parties. They share power. Historically, the stock markets actually have done the best when both parties are in power. And effectively, there's a shared power, if you will. So it's unusual that we have one party in power for very long. And this is, I think the expectation is that we will get back to what is more normal. At the same time, I do worry about the direction of policy and tax rates, and all those different things are very much up for grabs. And so I think ultimately the election 2 years after this year is a much more important issue. And I think the market is going to try to figure out what this election cycle coming up in November means for 2 years from now. I mean, the markets are looking ahead at that. And so, it's really going to be an interesting thing to watch. I think clearly the Democratic Party is shifting. The energy is more on the more progressive wing of the party. At the same time, the Republicans seem very solid behind President Trump, but at the same time, candidates that are somewhat up for grabs in other parts of these policies. Ultimately, we have a challenge, and this goes back to our discussion earlier about the Fed and the bond market. We have a lot of debt. We've got a lot of debt to roll over. Interest rates are going up. We've got, if you're the Treasury Department and you're looking at your outlays at this point over the next 3 to 5 years, I don't care who runs the show, you have a substantial increase in interest payments coming up as we go forward. And this is going to be a very interesting thing. So even if the Democrats gain control of the House, the Senate, and the White House in 2030, it's going to be hard for them to implement massive tax hikes and massive increases in spending, which I would argue that seems to be what they want. It's going to have an impact on the markets, and it's going to have an impact on the economy, and ultimately the bond market is going to be where all this gets decided from an interest rate perspective. The Fed has some control over that, but the bond market is it's weighing in, and the bond market right now is saying, okay, if you want to borrow from us, we demand higher rates, which is good for investors in the bond market. But there comes a point where rates get too high, and this we're talking about the bullish scenarios going forward. That's probably the biggest issue, I would argue, for the financial markets and for the economy. Is at some point, do we have interest rates and default rates and all of that at levels that become problematic for the economy? And right now, there's plenty of capital. If the Treasury wants to borrow money, if you're a successful company, whether it's in the private sector or whether you're publicly traded, you can borrow money right now, and your return on your capital is going to be higher than your cost of capital. But if, like, God forbid, if we wake up one day in 3 to 5 years or less or more, and we now have a much higher increase in the cost of capital relative to what we get on our capital, that's where we start having problems, and that will undoubtedly bring about a bear market.
Excellent. So helpful, Bob, at least for me. And let me see if I can summarize. What we have is an election in November. If the House goes Democrat and the Senate stays Republican, that would be perceived as a positive. That would bring consistency and probably not a lot of change, which the market does better with than what we would refer to as uncertainty. Markets typically price in worst case. And if the House, the Senate goes Democrat, I think the market will initially respond negatively, but eventually settle down. If the House, the Senate stays Republican, that would be a rally most likely. But I think all of these things will eventually settle down. And the fact of the matter is interest rates are going to play a bigger role. If interest rates stay at a point where we can borrow and get a return on capital greater than the borrowing cost, we're going to have the ability to continue to see the type of robust expansion that we're in the midst of. You're sort of forecasting out beyond, call it a year from now, which is helpful. Those are the concerns we have to keep our eyes on. But generally, we're seeing positive for I'd say the next year and a half, from what I'm hearing, from all the factors that we know to be accurate. Obviously, getting up every day to understand what's changed. I would say this, it's been telling, it's been trying. I had lived through the 90s as an advisor or a student of being an advisor and watching the markets really do nothing but go up. You had the word .com in your name, you went through the roof, even if you weren't making any money as a company. That felt good, like, wow, this is an easy job, but then we paid for it dearly. We had a market that was set up without retesting the floor below as we built that skyscraper called an economy in a market. And we saw the market pull back pretty aggressively in the .com bubble. And then we referred to the following decade as the lost decade because we had such a wide, broad uptick at like a slope upwards. What we've endured every year for the last several years is a market that takes 2 steps to 3 steps forward, contracts, and gets out the short-term traders, and then gets the long-term traders to continue to buy, resets and goes lower, whether it's the Mag 7 or whether it's a tech sector or whether it's healthcare or any other sector. And I see that as being extremely healthy, frustrating, but healthy. Hard to be a part of. And our job is to be the calm in the storm. And it's your brain and your narrative, Bob, that gives us that. Knowledge is power. You give us the knowledge. You give us the ability to understand, I believe, easier than most, what's happening, why it's happening. And my job is to take your information and others of the like, package it together and help be that calm in the storm and tell our clients, have a plan, know what you're prepare for the worst, plan for the best, which is the long term, and create that emergency scenario that we have learned the hard way during the '08 financial collapse to be prepared for. But then make sure that you're not being too conservative and you're planning for the future with inflation and making sure your money's working for you. Dollar cost average, have a plan. Don't get emotional and let fear or greed drive your decision making. Have those reviews to make sure you're 2 steps ahead of any changes. And I thank you, Bob, and I thank my audience for joining us, and appreciate you so much, Bob, over the decades and years. And you're a calm voice to me, and I hope to my audience as well. And I wish you the best. All the best
Jeff,
to everyone
thank
as
you.
well. Bye for now.
Take care.